In today's video, we will dive into 3 lessons derived from What Works on Wall Street by James P. O'Shaughnessy. Lesson number 1, the 7 considerations. Did you know that a lot of investors fail because they can't stick to one investment strategy? In the long run, they will lose to the S&P 500. 7 key considerations before investing in a particular stock. 1. Market capitalization below 25 million is usually a bad idea. 2. Price-to-sale ratio is the most consistent ratio to buy a winning stock. This price-to-sale ratio is often called the PS ratio. This ratio takes the market capitalization dividing total sales over a destined period of time, usually 12 months. In this book, the author calls this ratio the king of the value factor. According to Mr. O'Shaughnessy, PS is the most reliable factor out of all the ratios. We would like to aim at the company that has 1.5 or lower when evaluating this ratio. From our point of view, please make sure that this company will still be around 10 years from now. Some companies with this ratio might not be around 10 years, and investors should be careful not to fall for this ratio trap or any other reliable ratios if it doesn't meet the 10 years threshold. 3. Buy with a PE ratio is the most profitable way when the investor truly knows the stock. 4. Last year's biggest losers are the among worst stock to buy. 5. Last year's biggest gain alone is the worst stock picking strategy. 6. Own large cap stock with a high shareholders yield. For those that don't know what high shareholder yield means, there are 3 ways that a company can distribute profits to its owners. Remember, when we buy stock from a company, we are part owner of the business. Therefore, when the business profit, it will be great if we can have some of that profit too. Here are 3 ways the company can hand us the profits earned. A. Give it out in terms of dividends. B. Buy back its own share. This way less share is available on the market, the stock price will increase. This approach is only morally right if the company has excess cash and if the management truly believes that its stock is trading below its intrinsic value. C. Paying up their debts. With less debt, the less interest this company has to pay. Therefore, with this approach, the company will take in more profits next time around. 7. Relative strength is an excellent method to measure stock, but must add in many combinations to do it effectively.
Before we move on to lesson number 2, stick with it. Please, if you like what you are seeing so far, may you kindly with all your strength click the likes and subscribe button below. We really appreciate your kindness. Thank you so much for your likes and subscription.
Lesson number 2, stick with it. Please remember that successful investors are those that try to find a long-term strategy or group of strategies that have a history of winning and then stick with it. If we want to test our discipline, the author suggests that we buy the top 10 yielding stocks from the Dow Jones, and the best time to buy them is when a crisis hits. This strategy has worked for the last 75 years because it is not based on the emotion of the market but truly tests investors' sheer discipline to buy sounded companies when blood is on the street. So remember, when blood is on the street, have your top 10 list from the Dow Jones ready. In terms of dividend stocks, the author suggests that we should be careful with small stocks that give a high dividend. Trouble might be looming ahead. Some companies get into debt to continue dividend payments to maintain investor confidence. Such an approach is not only dangerous for investors but for the companies themselves. Please also keep in mind that high risks do not always mean high rewards. It is foolish to think this way because any fool can bet on a high-risk stock, as I did. Lesson number 3, the factors. Multiple factors. 1. Price-to-book value ratio, aim for 1.5 and below. 2. Dividend yield must be above the industry average or greater than 2% a year. 3. Price-to-earnings or PE ratio must be below the overall industry average. And, if you use the dividend to buy back the stock, is a double return to your portfolio. Please keep in mind to ask your broker for this concept. Some brokers will not do this automatically unless you ask them to. I hope this helps you because when I first started, I thought it is automatically that the broker will use my dividend to buy back more of the same stock, but that wasn't the case. So remember to ask your broker for this. Overall, find what strategy works for you, keep doing it, and stick with it. Don't let the strategy out of the window if you know it works. We hope this video somewhat helps you in your investment strategy. Which tips from this book were the most helpful to you? If you can leave it in the comment below, that is awesome.
Thank you so much for making it this far. Please join our newsletters. We promise no spam, only to update you when new summaries are available. We swear by the moon and the stars in the sky. We hope to see you in the next summary. Thank you so much again, you are awesome.